All right. We're going to be talking today about closing institutional limited partners. And before we begin on the how and all the details, what are institutional limited partners? Well, that's a good question. They are organizations, and that's the most important thing to note, that they're entities, they're organizations that make professional investments into venture capital. Okay. So there's a lot of limited partners that are not organizations. They could be angel investors, they could be high net worth individuals, and a variety of different types of individuals, from bankers to entrepreneurs. They're all interested in investing in venture capital, and a lot of them allocate money personally to venture capital. But when you start going after more professional limited partners, you're going to be dealing with organizations, and institutional investors are organizations. Okay. And generally speaking, they are harder to pitch and harder to close than individuals because they have more processes. So you have here a hard, harder, and hardest designation. So the hard limited partners to pitch are family offices and fund of funds. But in the scheme of things, they're a lot easier than, let's say, pension and endowments, right? In the middle category, you have banks and finance organizations, development agencies, and sovereign wealth funds. They're definitely harder in most cases than family offices. Now, of course, I just want to be super clear on saying there could be a family office that's harder than everything else, right? And that definitely happens. But on average, this is the breakout. And then some of the hardest ones to get into as an LP are pension funds and endowments, foundations, and insurance companies. And I'll talk a little bit about some of this because we have a lot to cover today. But let me bring up a couple things of note. A lot of institutional limited partners have a desire to make returns, right? Obviously, I think everyone investing in venture wants returns, but they also often have other motivations. Okay. So foundations will have strategic motivations. Development agencies, usually, that I skipped some words here. These are like government development agencies and things of the like. They definitely will have requirements beyond just returns. So they may want you to invest in a city or a country. They may say that a certain amount of the money that you allocate must be given to minority groups, for example. And that also can make things more difficult for you to close, because many times they'll demand that in writing, and hopefully those demands align with your fund thesis, but a lot of times they don't. Right. And so then you have to make some pretty difficult decisions. Do you want to comply with these complex requirements that are outside of your fund thesis to get this big pocket of money? And that can generally complicate things, which is, again, why some of these are in the harder and hardest categories. But there are other reasons that they're harder or hardest, right? For example, pension funds and endowments, they want to see a lot of track record. Now, so therefore, it's very difficult for a new manager to pitch them, because they'll say, well, what's your track record? Now, if you have previous investing track record, they may consider it. But a lot of times they're like, well, what's your track record with the current firm? And you're like, well, I'm on fund one or I'm on fund two, and I don't really have track record yet. So they're like, well, I can't really do it without track record. And by the way, if you do have track record, they're going to go through it with a fine-tooth comb, which is, again, why they're in the harder or hardest categories. But and there are pros and cons to taking money from institutional investors. Okay. The good news is they invest large amounts of money, right? And in fact, they are the largest sources of capital for venture capital, period. They have deep pockets, so they can do things like participate in follow-on rounds or co-invest. So once you get an institutional investor in, and hopefully they write a large check, there's more money where that comes from. And that means that they'll also usually plan to invest in multiple funds. So not only can you get a big check for your current fund, you might get some follow-on investment or co-investment, and they'll come into your next fund. So these are, for that perspective, they're fantastic. On the flip side, right, they're complicated to close, right? And we'll be talking about that in a moment. They're not fast, right? Don't expect a decision overnight. That won't happen. I mean, overnight after a year and a half, okay, but not from day one. And then they often have, as I was discussing before, special requirements of investing a certain amount in minorities or focusing on a geographic region. Sometimes they ask for special economics, and you have to, or even special information rights. And you have to make a decision if these are things that you can and want to do, right? And just to give a sense on how this ferrets out, like a regular LP, and I'm talking like that goes kind of slowly, might take 3 meetings and 6 hours of your time to close. And it might take a month, maybe 3 months, and you can get anywhere from $100K to $1 million, right? And that, I did some math on a mid-case scenario, and that runs about 40,000 an hour. So if you get a closed LP and you spend about 6 hours or $500,000, it's about 40,000 an hour, okay? Conversely, institutional LPs, right, at 10 meetings, sometimes more, sometimes less, but let's say like 10 meetings is pretty normal, especially when you factor in phone calls, because you might need to deal with different departments and a law firm and this and that, right? It could be a lot more. And at least 40 hours, right? Let's say 40 hours to be, so I don't scare people here too much about going after them, but I would say 40 hours is on the inside per institutional LP to close. And again, that's if you have all the due diligence. They're not asking you for very complicated things. You don't have to do original research to close them. There's a ton of legal comments, blah, blah, blah. And they take 6 months to 2 years. It could be more than 2 years. Sometimes they'll meet with you on fund 1 and only close on fund 3. But they can, invest a lot of money. Like I would say, generally they start at around $1 million. Of course, some come in less. And they can go way, way up to hundreds of millions, right? And just looking at sort of an average check size for a new and emerging manager, you're looking at about 125,000 per hour for a closed institutional LP, which of course is therefore a lot better than a regular LP, but it's also a much bigger time commitment, bigger amounts of money, etc. Let's talk about how to close them, okay? So you got to identify them. You got to connect with them, right? You don't want to submit like something on their website in a form. They're going to be at the bottom of the barrel. I think that's actually a form so that they can say like, yeah, we're not going to take money or give money to these people because they actually filled out the form. You really should try and find a connection into them and build that relationship. Then you're going to have to follow their process. And I'm going to talk about this in a moment. Go through their due diligence, negotiate, and close. And the thing that's most important about institutional limited partners that everyone here needs to understand is like, for most general partners, you're going to have your own process to close limited partners. It might be do a call, do a second call, get them to sign a pact, and then send them some information. If they want, send them a deal room. Like you'll have this all mapped out. And that will be the common thing that you do with most LPs in your fund. Institutional LPs have their own process. Maybe you need to have a series of initial meetings with them to get interest. Once that happens and they have some information, they determine if it's a strategic fit, right? They may need to have an internal sponsor, which might require more meetings on your part. If it's like, oh, you need to have so-and-so get interested. And so here's so-and-so, or you need to find an internal sponsor at our organization. Once that's done, another, more meetings on that, then you would go into, okay, you're a fit, you have this internal sponsor, now you need to do due diligence. And I can tell you that most institutional due diligence is much harder than you would expect. And we're going to talk about that a bit with Marko, but like you could put together a schlocky data room and it's just not going to cut it for institutions. They're going to want, I've had an institutional LP request 40 references. Okay, 40. I was like, I don't even know if there are 40 people involved in it was for a fund of funds, in a fund of funds right now. So because it was like multiple personal references of everyone involved in different categories of references for the firm, different categories of references for the fund. And I was like, and so we had maybe 10 or 15 references when in our data room. And as I said, they wanted 40. So that was a lot of work right there. And just to give you a sense on that particular one, we spent 40 hours just on their due diligence. Okay. Not all the other meetings and everything else. So when I said earlier, 40 hours, that's sort of like optimistic, right? Then they may do their own deal memo and submit their recommendation to an investment committee, an IC meeting. Investment committees for larger institutions don't happen every day. They certainly don't happen every week. We run one every week, but most don't. They could be quarterly or monthly, so you have to wait for that. The IC says we like it. Then you might go into a detailed legal review. You might get comments on your LPA that could be already signed, right? So could be a big problem for you. We got to change the LPA because we're bringing in this big institutional investor. Take a lot of time. And then sometimes you have to negotiate, right? Because they'll ask for side letters or they'll ask for changes to your LPA that you don't want to do. So just to give you a sense, I mapped some of these times down below. And as you can see, it's like they add up to like 15 months or more. And I would say like a fast closing for most institutional LPs is in like the 6 to 9 month range. Kind of like a normal closing might be 9 to 18 months. And a slow closing is 18 months or more. Okay. And more could be years. And we'll talk about that in a minute. So let me give you some tips. As I mentioned before, tip number one, you got to find a strong connector. It's just going to increase your chances, and your chances aren't very good to begin with. So you're going from like very low chances of any institutional LP investing in your firm. And you've got to basically do your best to inch those chances up, and getting a strong referral into them will help a great deal in that process. The next thing, and a lot of GPs don't do this. This is one of the most, even experienced GPs don't do this. You need to learn their process and their timeline, and then and their criteria, and decide if you want to proceed. Because they may say, look, this is going to take 18 months. It's going to be really hard. And you're going to have to invest in, 10% of your money in Senegal. And you're like, I don't want to do that. So if you don't know what their process is, if you don't know what their timeline and criteria is, then you are going in blind, and you may get to the end and they'd be like, okay, now you have to put 10% in Senegal. And you're like, whoa, I can't do that. And you just burned 80 hours of time to get there. Okay. Once you start this, you are going to have to follow their process, right? You're going to have to do their criteria. And a lot of VCs are kind of like mavericks, do things on their own, like, lone wolves. No, not with institutional LPs. If they say jump, you say how high, right? That's how it goes. It's their money, their process. And you like, if you're not, and you're like, man, they're making me do this, man, listen, you wanted to go after institutional LPs, you follow their process. Okay. That's it. So you got to resign yourself to go through things that might not seem to make any sense at all, but that's the game you've chosen to play. Right. And they're going to inundate you with due diligence requests. One of the biggest ways to influence the time scale is if they ask you for something, get it back to them in a week, right? But if they dump a big due diligence checklist on you and it takes you a month or two to do it, which is not uncommon, you've just lost a month or two of time, right? And here's another tip. They're going to ask you for some things, and it's okay to say no, right? Now, you might lose the deal, but you also have to have boundaries. So you're in their process, you have a pretty good sense of what it is, but out of the blue, like they're saying, hey, look, I need to call your family members. And you're like, listen, I don't find that appropriate. No, right? So it's okay to say no, especially if you're uncomfortable doing something. But a lot of managers get kind of half into the process, and they're like, oh, they're asking for this. I don't feel right about it, but I don't want to lose the deal. You should never do something you don't feel right about, ever. And if an institutional LP is asking for something that makes you uncomfortable or you think is unfair, just say no, right? You have to have boundaries. So I want to go back to sort of a traditional timeline, but not of how just to close an institutional LP, but how to close your fund and have institutional LPs participate. Very rarely, and I can't even think of any examples, do institutional LPs participate in your first close. Most will come in later. There are occasions where institutional LPs will anchor funds. That's increasingly rare. It does happen, but it's rare. So most of the time, they're going to come in later. But so in a traditional, if you're closing your fund, you're going to get a first close done. You're going to do some initial deals, and you want to start preparing to pitch institutional LPs because they're not really going to come into your first close. Then a few months later, months 7 to 12, you're going to be working on your second close. You're going to be building an investment track record at this point because you will have done deals. You'll have deals in the pipeline. And that's a good time to start discussing it, and reaching out to institutional investors and LPs. The issue is that they take so long that if you don't start, you won't have them in. So if you've got 3 months left in your ability to close your fund, you're not going to get institutional LPs. They just take too much time. So you want to start when your fund has some momentum, it's got a bit of track record, you're beginning to operationalize things. And you still have maybe 18 months to close the fund. That's a great time to start talking to institutional LPs. In the next chunk, months 13 to 18, you'll be working on your first close. Hopefully, you'll have some markups in the portfolio, and you might begin your institutional due diligence process. And then in the last months 19 to 24, you're working on your final close, your fund's operationalized, you're sending out beautiful reports, everything's working really smoothly. The institutionals will see this and be impressed, hopefully, and you can close them. Right? And you should know, as I mentioned, that institutional investors avoid new managers. They're usually prevented by charter from investing in new managers, so managers working on first-time funds. They generally will avoid first closes. And you can ask them this, right? Do you invest in new managers? No. Okay, thank you. Or yes. Okay. Well, how many new managers do you invest in? Like, one a year. And then you could say, okay, well, like do I even fit the criteria? Well, not really. Oh, thanks for letting me know, and leave. By the way, if you don't ask questions like that, a lot of times they'll continue the process, right? And I'll talk about this. They're looking at fund 3 or whatever. So you'll go through all this process, and at the end, they'll be like, yeah, we're not going to invest. Why not? Well, we don't really do fund 1s. What? Why did you do all this with me? Well, we're really looking at fund 2 or fund 3. They're like, you know, and it's really a shame on you. You need to ask. And as I mentioned, they have a complex process and they'll often require special terms. And so it can take years to close institutional LPs. And as I was mentioning and said multiple times, sometimes they're meeting with you on fund 1, but they're really thinking about fund 2 or often even fund 3, right? And if you don't know that, that's your issue. Your job is to figure out, wait a minute, they're trying to get me for fund 3 and I'm on fund 1. This isn't really a great use of my time. And speaking of which, they rarely say no. They are notorious for not saying no. And there's a lot of reasons for this. You're talking to someone that doesn't have a long job, right? Because the institutional LPs rotate people, right? And so, like, it doesn't benefit their career to be saying no to you, right? On top of that, they're thinking about fund 2 and fund 3. So what ends up happening is a lot of these institutional LPs, blow sunshine up your tuchus because they want to keep you around. And that phenomenon is called LP love. And so you're going to be like, oh, Adeo, you don't understand. Bank of America loves me. I'm meeting with them twice a week. They invited me to events. They just love me. And you know what? That's called, like, you're an idiot, right? If you don't know what their process is, and I can tell you Bank of America, just as an example, institutional LP has a great program for new managers, and especially diverse new managers, but they've run out of money. Now, interestingly enough, they're continuing to put people through the process as though they have money, but they don't, which is crazy because they're like, well, maybe I'll get money next year. So I'll just keep the process going so I can have a backlog of managers so that if I get money next year, I can invest in them. Like, so, hey, do you still have money? No. Oh, why am I going through this process, right? So LP love is a real thing, and it's really a giant waste of your time. But at the end of the day, institutional LPs provide the largest source of capital for venture capital. So it's really, your job to manage that process well and close them, especially as you work on fund 2 and fund 3 and get to larger fund sizes. So we're here to help, and I want to turn it over now and ask some questions. Marko comes from an institutional LP background. So Marko, why don't we get started? You introduce yourself, and then I have some questions for you.
Okay. Yes, brief introduction. I started in this business around 1986, which is about 37 years ago. Co-founded a couple of companies, was an entrepreneur, got some exits, went into family office business. Around year 2000, I started as a GP, investing in venture capital, pre-seed, seed companies 1 year before the dot-com crisis. Around 2006, I was asked to join a public pension fund where I was running the private equity and, the investment program. We invested in funds, different funds, buyout funds, venture capital, emerging managers, even first-time managers, secondaries, both buy and sell side, private credit, private debt, co-investments, direct investments. And I was there for about 15 years, and I know something about it, so to speak.
So let me look, how many, you've done a lot of emerging manager deals, but how many have you done?
I haven't counted the total amount, but I've been involved with, I would say, maybe all fund investments would be around 300, maybe, but I haven't really, counted that. But if we think about emerging managers as fund number 1, 2, and 3, quite a few of these investments were into emerging managers because I started quite early, and there were not too many established managers when I started in this business,
Yeah,
So
right. Exactly.
yeah,
So,
yeah, most of them were first-time managers, when I started. But maybe 50 to 60 co-investments and directs.
so talk to me about maybe what you see as the common challenges when you, because you probably looked at a lot more to get to the 50, 60. So what are sort of the, if you were to say, oh man, most emerging managers do this, it's a mistake and they should do this, which would be better?
Yeah, I think that if you think about, some pieces of advice for emerging managers when they are pitching or trying to get commitments from LPs, number one is that they have to reach out first, They have to try to meet these people. It's people business. The second one is that you have to come prepared and do your homework. I've met a lot of GPs who didn't know anything about us. They just came in. And some of these guys, they were so focused on the check, with not trying to build a relationship, They had that kind of one size fits all, pitching, which doesn't really, it's not a good idea with institutional LPs. It's all about building relationships,
And yeah, keep going.
Yeah, the other one is that you should think about your fund maybe as a product or a service, because it's a product or a service. What are the key features? What are the benefits? Stuff like that. Is your size, strategy, team optimized? What are the competitive advantages? The other thing is that, as Adeo explained, that you should start pretty small, even though you might think big and go fast, which means that even the institutional investors understand that some of these small funds can outperform. But for you, it's important to get the deals done, before you actually pitch to the institutional investor. So don't be worried about starting with a smaller fund. And then one thing is that my mother always told me, boy, son, that you have 2 ears and 1 mouth. It's a good idea to listen to the LPs, what they have to say, Sometimes,
One now. Yeah.
yeah, I mean, it's a very good idea because sometimes what happens is that the GPs are so nervous when they get the chance that all they do is talk, they don't listen. And LPs, they tend to have an idea of what they want to invest in,
So
Those are the practical, stuff.
I have a lot of questions about that. We have some questions coming into the Q&A, but let me, so like when you were doing these institutional investments into funds, particularly emerging managers and new managers, because that's the audience here, what would be your, like, let's say it moved fast, how long would that take? And let's say it moved slow, and how long would that take? And I mean, obviously there'd be some that you met like 10 years ago and decided to invest. Let's exclude extreme outliers for random reasons and sort of talk about the fast average and the slow average.
Yes, I would say that the extreme fast, which we made, were between 6 to 8 weeks, under 2 months. But there were some really good reasons for us to do it. These are really outliers. There were some extremely good reasons for us to do it. The slow ones maybe took 4 years. But the normal stuff is anything between, 6 to 12 months, something like that.
4 years, everybody.
Yeah, but it meant that we met these people when they were raising their first fund, and we made the commitment on the third.
Right. So that's pretty common, right?
Yeah.
So let's just double click on that for a minute, right? So if I'm now let's, because you've been on both, you've been actually on all sides of the table, as I like to say, because you've been an entrepreneur, a GP, and an LP. And so let's go into, though, now I'm a GP and I got this pension fund or whatever, and they're interested in what I'm doing, but I'm kind of sure they're not going to invest in fund one. And even they say they often don't say we're not going to invest in fund one. They say things like, we're probably not going to invest in fund one, which you have to interpret as a GP as they're just being polite and they're telling you they're not going to invest in fund one. What do you do as that GP to engage this larger LP through fund? Do you put them on a newsletter? Like what would you like to have seen the GPs do?
Yes. First of all, the reason I joined the pension fund was that I wanted to understand how they made these decisions, because I couldn't understand it. I was curious when they asked me to join. I just couldn't understand it, because sometimes I saw that some managers got these commitments when they didn't have that strong track record or something like that. And then again, I saw that some guys didn't, where they had that strong track record. I couldn't understand that. But it's very much about relationships building. Right. It's very much so. People don't understand it. And you have to be patient. You have to be polite. When they cannot make a due diligence on your track record, they are making a DD on your character. And you kind of have to understand them and get to their side, so to speak. And it means that you really should be able to send them some updates, what you are doing, sometimes try to call them or have a Zoom meeting, maybe able to meet them one-on-one in person if possible, because it's going to take some time. Some people told me that you should make at least 5 different one-on-ones with them. And then they kind of start to think that they know you.
And that's even before you start the process.
Yeah, before you get the money from them, and it might take a couple of years in that sense,
Yeah, so these are, and that's the most important thing. Like, there's their process, there's the relationship building. It just takes a lot of time. We got a lot of questions. So
yeah,
in
but
Q&A,
one thing maybe I would like to mention about the process, I think that the most important thing is to find the internal sponsor.
Yeah, exactly.
If you find it, you get the money. If you don't, it's extremely difficult.
Okay. So if you're just going through their this is a great, and maybe I should have put that as a tip. So we'll amend and add a tip, which is if you're just going through the process, you might have someone who's like running the process. They may be super nice to you, but you really need an advocate for your investment in the firm that works at the institution.
Absolutely, because there are going to be many internal discussions in the pension fund before they make the decision. So there has to be that kind of person who is actually on your side, who wants to do it. And then, the magic happens. If you don't find those internal sponsors there, it's extremely difficult.
Awesome. All right. So let's get to some questions. Some of these I can answer really quickly. So Mode is asking, hi, how do we get the lists of LPs, right? And how do we start building relationships? So like institutional LPs are probably the easiest to find. The presentation included all the different kind of categories of them. And so Some are harder than others. Like family offices are often very obtuse, whereas like pension funds and endowments are kind of like right there out in the open. It's like there's a university, it has an endowment, like um, so that it's harder to find things like family offices, but most of the others are kind of easy to find. And then you just have to find connectors, people that you know well, that know someone that work at those institutional investors. Lance is asking, who do you recommend for your first close? So your first close for most venture capitalists entering the field is universally going to be first degree connections, people that you know. Often, sometimes it's people you know at companies, but most of the time they're individual investors, high net worth individuals, um, angels, successful executives, and things like that. We have a whole article on LP archetypes. Why don't you share that in the chat, Niels? We will be recording the session, Simon. Hey, Niels, if you could screen some of these questions that are kind of obvious or type answers in, that would be great. Okay, this Daphne has a question that'd be great for you, Marko. So she's asking which channels, such as events, direct introductions, etc., are most effective to reach out to institutional limited partners?
In the past, I would say that it was about these events. But the problem nowadays is that even if the LPs get free tickets, it's pretty difficult to get them to attend to these events. And it's because if you are into these events, you kind of know what's going to happen there. A lot of GPs want to talk with you. So it's a little bit more difficult than it was in the past. I think that the connectors are still the best way. If you can find those, sometimes I would say that it can be almost a coincidence where you can meet these people. It might not be the trade events. You might meet these people somewhere else, which can happen. And it's sometimes you need to know the guy who knows the guy. That's about, how you build networks. It's sometimes enough if you want, get to know one person who likes you and who is able to help you with his or her connections, and it takes time.
Events aren't bad, but yeah, connectors are the best.
Personally, I like events because I was one of the few LPs there who attended these events, even though I knew what was going to happen because I wanted to meet the GPs.
Well, we met at an event.
Yeah, we did. Yeah, we did. Yeah.
So, yeah, I mean, go to events, but don't go there hunting institutional LPs because they, as Marko was saying, they're super rare, right? It would be like, I'm going to hunt the woolly mammoth. Like, you can hunt the woolly mammoth for a long time. You may not find one, right? So you go without the expectation of finding them, and then it can be, happenstance and good luck fortune if you do. Emil's asking, can you talk about capital raisers such as brokers or dealers, stuff like this? So no one here is going to work with those people, okay? Broker dealers tend to work with larger funds, right? And they do charge fees. Almost no broker dealer works with a smaller fund because A, there are no fees in it for them. B, these large capital sources don't invest in these new managers and smaller funds. And so if someone's telling you that they're a broker dealer, they're a bottom feeder, and they're probably doing it illegally as well, because you need licensing and registration in most countries in the world to be a broker dealer and take fees. So, if you like, if someone's like, yeah, I can help you raise money, like A, they're a bottom feeder, and B, they're probably doing something illegal. So avoid. Alexander, sorry if you want to add anything there, Marco, but
I think it's about what you said. We have a couple of good so-called placement agents, which is about the same thing. But these people normally work for the really big established funds, you know. They want to raise 500 million for them and get paid for it. They want to get 10 million out of it. So that's how it is, you know.
right. And they take 2 to 5% in various structures. So they could take like 2% up front plus another 3% over this. So they're expensive as well. But again, that no one good is going to work with you as a new or an emerging manager. And Marco just said the same. So Alexandra is asking, are corporate venture capitalists decent LPs? I'd love to hear your views on this, and then I'll add my views second, Marco.
It depends. I know some, and they if they get interested in you, they would probably write a relatively big check.
Right.
They could do that.
I didn't include, usually corporate venture capitalists are not considered institutional venture capitalists. And there's a lot of, or corporates are also not considered, because institutional venture capitalists generally have venture programs that's part of their investment philosophy. They have teams set up to do the due diligence. Corporates, you know, they run the gamut. They are organizations, but they don't generally professionally invest in venture capital. Oftentimes it's a side gig. And I can tell you that that's both a pro and a con. So I've seen, like, literally a good friend of mine had Bayer as a major investor in the corporate venture capital thing. They switched their strategy and stopped funding, right? And that happens, right? You're a big company, yeah, you have a bad quarter, you have another bad quarter, you're like, well, we got to cut. What are we going to cut first? Venture capital. Like, and you're like, whoa, but like, that's me. I am, so yeah, I wouldn't be over focusing on them. They're not bad, but they're like in between, a regular LP and an institutional LP is this weird corporate group, and it can be in a variety of different good and bad states. Okay, lots of other questions. I'm talking to a large PE firm that invests in VCs alongside many other vehicles and seems promising. Is this an institutional LP category or just a fluke? Marco, do you want to take that one?
I just didn't understand really.
He's saying that there's a PE firm that wants to make an investment in his VC, and is that common?
It's uncommon.
Yeah. So guys, this is another thing. So VCs sometimes make investments in other VCs, and PE firms sometimes, like Tiger Global, Andreessen Horowitz is talking about doing this right now.
Goldman Sachs as well.
Yeah. And so it happens, right? But there's a lot of reasons that it doesn't happen often. Now, reason number one is there's conflicts, right? If I invest in this thing and it's, that's, and it may invest in something that I would invest in, there's conflicts there, right? So you don't want to create conflicts where it doesn't need. There's, in addition to that, there are double fees. So I'm charging my investors fees, right? And you're charging your fees to your investors. So a PE or VC firm that goes into another VC firm gets double fees, right? And so normally, so again, there are lots of reasons this doesn't happen. If it seems like it's going great, but just keep in mind that the probability of VCs and PE firms investing in other firms from the outset is very low. Okay. So Nikhil's asking, like, would you recommend doing research before the meeting to understand more? And Marco actually did exactly recommend that. But so I want to take this question to you, Marko, a little bit deeper, because you brought it. This is one of the key tips. What would you recommend GP specifically researches before pitching an institutional LP? Do you recommend people?
This is classic because it's know your client, regardless of what you are selling, you know. It is the basic thing to do. You at least should know, if you can find out what types of investments they have made. If you can find that out, and sometimes you can find that out, that's the basic thing. If you know anything about the strategy and stuff like that, even better. Sometimes you might be able to find something about the person you are going to meet, you know, which is always a good thing. Something about their background and stuff like that. It's basic stuff. You don't have to overdo it, in a sense that it would be an overkill, but you should have some basic understanding of what they are doing or what they have done, you know.
Okay, this is so if you go in with no idea, that's terrible.
Yeah, I can tell you one thing. I met a guy from a big PE firm around 2012, and his first question to me was that, do I know anything about them? I said, yes, I do, because we have invested in your fund since 2007. And that happened with a guy from a big firm, and it can happen. But, you know, thing is that you should be, you know, be prepared and do your homework if you want to be successful there. It doesn't take a long time. Nowadays, you can find out certain things, you know, but it's still pretty usual that they don't much about the LP.
Okay, there's some great questions here, everybody. So let's do me a favor, go into the question things, put the upvote. We'll try and get through as many as we can. I like this question again, also a second question from Nikhil. If you're beginning a conversation with an institutional LP and maybe there's only 6 or 9 months left in your fundraising period, is it possible to push them to close on your time schedule?
Within 9 months, it should be.
Yeah, 6 months might be a little tight.
Yeah, it might be a little bit tight, but under 6 is very difficult.
Yeah, so, okay, so that's actually a super important thing for everyone here to understand. 6, under 6, kind of like a no. 6 to 9 is possible, okay?
And also, if you meet them like the end of May, you know what's going to happen. June, July, August. It's already 3 months off, you know.
That's a great point. Can you put the seasonality article in there, Niels, into the chat for everybody? So here's seasonality is real. And if you're going into an institutional LP and they're all going on holiday, and that's your 6 or 8 month window includes the June and July, it's not 8 months now, it's 6 months, or if it's 6 months, it's 4 months, because you can sort of take some vacation months out. There's easily a month at the end of the year and a month or 2 over the summer that institutional LPs will move slower. And it's not even that they're moving slow. Just as a quick aside on that, they may need to have 5 people in a room to have a discussion, and 4 of them are on vacation, right? So it's not like, so they're like, okay, when so-and-so, and then the other one goes on vacation, and then finally it's a few months later, everyone's there. Okay. Brilliant is asking, what does a great track record look like? What does a poor track record look like? Which I think is a great question.
It is a difficult question as well, because, you know, the best LPs, institutional LPs, they understand that if you're a young manager, first-time manager with a limited track record, it's not to be, they cannot expect much, you know. They cannot expect anything from the DPIs before the 4th year, even though you might have have 2 or 3 funds already going. They understand that it takes up to 5 to 6, even 7 years before you get a reliable track record. They understand that. So if they are evaluating that, but at the same time, it's all about the team strategy and stuff like that. So it's difficult questions to answer, because some people misunderstand that track record. Some LPs, they have requirements that are impossible.
Right. So they could say, look, I don't want to talk to you until you get at least the 3x. Right.
Yeah.
Well, it could take you 8 years to get a 3x as a VC, especially as DPI, which is cash on cash, versus, an unrealized VPI or something like that, which is, kind of markups in the cloud. Right. So if someone's saying like, look, when you get a 3x, and you're like 3x unrealized or 3x cash on cash, and they're like 3x cash on cash, you're like, oh, I'm not going to have that for 8 years or more, right? So that's super important to understand. So track record, a lot of I would say most of the institutional LPs don't put a lot of credit in unrealized gains, and they put a lot more credit in realized gains. Would you say that's accurate as well?
And it's more than ever, because the DPIs have been pretty poor since 2018. But I think that is about to change sometime in the future, because you can't really rely only on the DPIs, because that is also a mistake.
So this could be another problem. If you go to an institutional LP and you're like, what are the criteria? We like to see positive returns. And let's say it's reasonable. Let's say it's 2x. And you're like, okay, is that unrealized or is that cash on cash? And they're like, oh, cash on cash. You're like, okay, well, I can't do that because that's going to take me a number of years. So walk away. And again, it's on you to understand these things. Now, we got like a minute left, and this was really amazing. So I'm going to ask you for some final advice in a second. And I want to thank everyone for coming out. And I hope this was super helpful. But here's what I would say. If you're interested in getting your fund off the ground, we're doing a big institutional LP push right now at VC Lab to help our alumni in the right situation get an opportunity to pitch and close institutional LPs if they can. It's usually most institutional LPs do not come into fund one. Okay. So they may come into fund two, and it's more likely for fund three. But again, you can apply to the program, come in, and we'll help you with all this stuff in much more detail. But Marko, do you want to leave everyone with some closing thoughts on best practices to close institutional LPs?
It is basically that you have to understand that it takes some time, it takes a lot of effort to do it, and be patient. And if you're able to close money from private individuals, high net worth individuals, you are going to be able to do that with institutional investors as well, but it might take a little bit longer time.
Right. And so that's another thing. They have a long-term mindset. Okay. You also need to have a long-term mindset, right? Because if you're like trying to get them to close, and they're like, yeah, I just want to meet you again for some coffee to get to know you, that's going to create problems, right? And so, a lot of the institutional limited partners that I'm engaging with, I understand that they may not come in until fund three, but just keeping them as friends and keeping in touch with them, sending them newsletters and things like that's important to do. All right. Thank you, everybody. Thank you, Marko. This was amazing. Hopefully you learned something. If you did, I'm seeing lots of congratulations in the chat. On social right now, and maybe Niels, we can do a link to it. We have this presentation up. We'll be sending you the video as well later today. Thanks, everyone.
Thank you.